Hello, welcome back. In this video, I'm answering the question about what is this 20% of income deduction? You may have heard of it. It's called the QBID deduction, stands for Qualified Business Income Deduction, otherwise known as the 20% deduction. In this video, I'll be breaking down how that deduction works, who qualifies for QBID, if the QBID is calculated on gross income or net income, if self-employment, Schedule C income qualifies, exactly what type of net income qualifies for this deduction, if sole proprietors get it, as well as exactly how the calculation works for this 20% deduction. So basically we're going to have a little crash course, and I have a QBID calculator to show you at the end so that you can calculate how much your deduction is. Let's jump in. If you're new here, my name is Amanda and you're watching The Business Finance Coach, where I simplify all the technicalities of business to help you succeed, because I truly believe that the world needs your business and you shouldn't be held back by all of these aspects of our civilized society. You should be able to understand these things, and I try to make them as clear as possible here on my channel. Let's jump in to covering what the QBID deduction is and how you can take this 20% deduction for your business. So how does this 20% pass-through business deduction work? So it starts with 20% of pass-through income from a trade or a business. And it's true that we never have had a deduction like this. This is a deduction amount based on a percent of income. So what does it mean by pass-through income from a trade or business? If we take a look at my cheat sheet here, we can see it starts with tax types of businesses. So this isn't the legal side. That's why we don't see LLC. This is the tax side of things. So the first one is self-employed, meaning there is no separate business, and we can see under how it's taxed, that's a pass-through or flow-through entity. Same thing with the partnership, and same thing with the S-corp. And what that means is that with all these tax entities, the business doesn't actually pay any taxes. The activity flows through to the owners. In the first case with self-employed, that's a business that's not separate from an owner, and a rental activity would qualify as well on Schedule E. The self-employed is a business activity reported on Schedule C. Both of those scenarios are where the activity is reported with the owner's personal tax form, and they both qualify because they're trade or business. In the partnership and S-corp, the business files a separate business tax return for the business activity, but the activity flows through to the owners on Schedule K1s. There might be one Schedule K1 and an S-corp for all of the activity going to one owner, or there's multiple owners and each owner just gets a share of the business net income based on how much they own or special allocations. So when people are wondering, is the 20% on the gross income from the business or net income? The answer is it's on net income. So every business has accounting reports that summarize the business activity. So this would be the information from the income statement, where we have income or sales or total revenue minus expenses, and that gives us net business income. And so it's that net business income amount that we are going to times by 20%, and that equals the amount of the deduction. So if you're the only owner of your business or rental property, it's that entire amount times 20%. If you're in a multi-owner business, it's your share of that net income times 20%. And this deduction is taken on the personal tax form, Form 1040, our individual form. You can see here on page 1, line 13, qualified business income deduction. And you can see it says attach Form 8995 or Form 8995-A. And that's the form that we calculate the qualified business income deduction on. So now we need to talk about the limitations. The first main limitation that applies to everyone is that 20% of your flow through business income, that amount is limited by 20% of taxable income. So if we come back to our Form 1040 here, we can see taxable income at line 15 right below. So this is kind of a circular calculation, but we're looking at taxable income times 20%, and we're going to take the lesser of those. The next limitation is based on if your total taxable income goes above a threshold amount, and if it does go above that threshold amount, then we need to look at what type of business do you have. Is it considered a specified service, trade, or business, which is otherwise abbreviated throughout everything about this deduction as SSTBs. And this is a category of businesses that was defined just for the 20% deduction. So that's why you've never heard of this, because it's a category that's been made up. And it seems quite random and arbitrary and very nuanced as we look at who is in this category and who isn't. But basically, let's take a look at this threshold. So if you're single or any other filing status as of the last day of the year, and your taxable income is above $163,300 up to $213,300, then the deduction is going to phase out over that range if you are considered an SSTB business type. For married taxpayers filing jointly, their threshold amount is $326,600, exactly double what the single threshold was, and they have exactly double the phase out. So it's $100,000 over which the deduction will phase out if your business is an SSTB. So how do you know if your business is an SSTB? Let's take a look at this detailed breakdown, courtesy of Intuit, and kind of taking these pieces from IRS interpretations of the laws that have come out. There's been quite a bit of back and forth about this over the past few years since the 2017 Tax Cuts and Jobs Act, and now they've narrowed it down to this. And the general definition of an SSTB started out with a trade or business involving the performance of services in the fields of health, law, accounting, actuarial science, performing arts, consulting, athletics, financial services, investing and investment management, trading, dealing in certain assets, or any trade or business with a principal asset, the thing that's making the business money, is the reputation or skill of one or more of its employees or owners. I mean, what business doesn't that apply to? But they didn't use that to bar all of us from basically being an SSTB, and instead they've now provided a lot more details that break out who is and who isn't. So these are the terms here on the left that I just covered in their initial statement, and then we've broken it out into included fields and excluded fields. So for health, people who are SSTBs are physicians, pharmacists, nurses, dentists, veterinarians, physical therapists, psychologists, and then people who are excluded are services that are not directly related to medical service fields. So operation of health clubs or spas, payment processing for the medical industry, research, testing, manufacturing, and sale of pharmaceuticals and medical devices are excluded. It's interesting how those far more profitable industries are excluded while the people who are working are included. Remember, being included in the SSTB means that the threshold and limitation applies to us. In law, there's lawyers, paralegals, legal arbitrators, mediators. They are included in SSTBs, and it's only other services that are related to law that are excluded. For accounting, accountants, enrolled agent, tax return preparers, financial auditors, and all similar professions are excluded. Same in actuarial, performing arts, actors, directors, singers, musicians, entertainers, they are all excluded. But services that do not require unique skills to the creation of performing arts, such as maintenance and operation of equipment or facilities for use in the performing arts, or in the provision of services by persons who broadcast video or audio of performing arts to the public. So you can kind of see this. Now, consulting is a huge area, right? Persons providing clients with professional advice and counsel to assist in achieving goals and solving problems, and persons providing advice and counsel regarding advocacy with the intention of influencing decisions made by government or governmental agency, and lobbyists attempting to influence legislators and other government officials on behalf of a client and other similar professionals. So this is lobbyists, consultants of any type, right? Providing people with professional advice. So what's not an SSTB in the consulting area? Performance of services other than advice of counsel, such as sales or the provision of training of educational courses. It also excludes consulting services embedded in or auxiliary to the activities of a trade or business that isn't SSTB. So that would mean if you provide a little bit of consulting with a product, so I'm thinking of these spa pools where a company is selling these big spa pools, they're really expensive, no sound and deprivation tanks. And so they may provide a bit of consulting included in the $30,000 cost of the pools, but they're not charging you for that separately. And so that wouldn't disqualify you. It also sounds like I might not be thrown out for my educational courses, even though they are in the area of accounting, which is specifically excluded, at least some of them. Moving on, we have athletics, and it's basically the same pattern that we've seen. Financial services is a bit more broad of an area, and so they've gone into a bit more detail here, but it continues on. And if people have questions, do let me know in the comments below. We could go deeper on this. And most people I've been talking to, it's been pretty straightforward whether you are an SSTB or not, based on this added detail that we have now. So once you are not an SSTB and you're above the phase out, there are two other limitations that are going to come into play. The first is that QBID cannot exceed the greater of two things. One, 50% of the business wages, so that's W-2 wages paid to employees, or the owner's share of that coming through on the Schedule K-1. The businesses have to report this information for its owners, or 25% of wages plus 2.5% of the real property that the business owns. Now, this has a special name called unadjusted basis immediately after acquisition, which of course is abbreviated UBIA. And so that's 25% of wages plus 2.5% of the essentially real estate that the business owns. And it's basically the investment that the business made in that property and assets, because we're using unadjusted basis immediately after acquisition. That's generally going to be what we paid for it and all the costs that went in to that asset being ready for our intended use. So that would be the most value that our assets are ever at in the time we own them, typically. So you take the greater of these two and compare it to that 20% of the pass-through net income, and the lesser is going to apply. This is a limit. So again, and this limitation applies to businesses that are not SSTBs and are above the phase out. So we've covered how the QBID deduction is calculated, on what amount qualifies, the net income that flows through from a trade or business, from a pass-through, or just on the owner's return. That 20% is limited to 20% of taxable income, and then it depends if your taxable income is above that threshold amount, and if your type of business is considered a SSTB. If it is, then your deduction ends after that phase-out amount. If it's not, then we have this second limitation that's based on the greater of 50% of your W-2 wages or 25% of your W-2 wages plus 2.5% of the unadjusted basis in your real estate. So we take the greater of those, and that's the limit. So we'll take whichever is less between our 20% of the pass-through income and that greater of those tests. Now, I, of course, have a spreadsheet template that allows you to calculate this. So here we are in my QBID calculator, and this actually came from my business types comparison spreadsheet template, because in order to compare what your taxes are going to be like under the different business types, the QBID deduction plays a huge role, right? This 20% pass-through deduction. You can see it's not allowed under the corporate structure. And so
we actually needed an entire worksheet to account for the other stuff that the owners have going on in their return. Now we are going to focus on the simple calculator here. So the first thing we need to do is put in all of your taxable income, W-2 wages, interest income, net real estate income, net business income. So we include the amounts that are going to qualify for the QBID here, but also everything that you would have on your tax return, as well as your spouse's activity. The one thing we don't include are capital gains. Capital gains are when we sell things that we own for investment purposes, such as stocks or real estate. So you can see I've added a business here. Our net income from our self-employed business is going to be $50,000, and we have W-2 wages of $50,000. So we got a job and a business. Now when we come down here, are you a SSTB? We just covered this. We got to say yes or no. So we'll say yes. Here we select our filing status, single, married, filing, joint, head of household, and that will change the standard deduction here that brings us down to taxable income. And of course, this taxable income number is what we're comparing to the threshold amount. So when we're married, you'll probably remember this number, 326,600. And if we are single, it's the half of that. And so we're summarizing down here with these two questions for the calculator to work. And it's telling us we're below the phase out, and are we qualified for the deduction? Yes. From the information under taxable income, we need to put what applies for qualified business income. So in this case, it's just the business at $50,000. If you have real estate investment trusts and publicly traded partnerships, these are primarily real estate investment vehicles, then you would get Schedule K-1s and need to account for that income and loss here as well. These amounts can increase the 20% deduction. So here's the QBID calc for people below the phase out. We're either going to take 20% of our QBI income, 50,000 times 20% is 10,000, or 20% of taxable income, which is this 87,800, which is 17,560. So the lesser of these is the 10,000, and boom, we get to take it. Okay, so now let's try an example where we're above the threshold. So if we come back here and we add in 150,000 in our business, so we'll make some more money, and you can see now our taxable income is between the phase out. So now it says we're in the phase out. We need to update our qualified business income to our full amount. So now our 20% of QBI is 20,000. And our 20% of taxable income is 37,000. So we're still going to qualify to take our 20%. We're not going to be limited by taxable income. If we're a specified service trade business, then we probably don't have wages to the owner. We probably don't have any value in the property. So these tests aren't going to apply. But because we are in the phase out, we are still going to qualify to take a deduction. It's just instead of it being $20,000, it's phased out over that $50,000, and therefore we're only going to get $10,200. Now let's look at above the phase out. If we go above the phase out, and so let's say we've got $300,000 from our business. Now we're above the phase out, and we have no QBID because we are an SSTB. If we go ahead and change that so that we're not an SSTB, then we qualify. We just have an additional limit. And so let's say instead of this being a business, that this is real estate income. Now we need to update our QBI, and now our preliminary QBID based on our total QBI is 20% of 300,000, 60,000, and our taxable income limitation is still above that, right? Because we have that extra W-2 wage. So now let's say in our real estate business, we have no W-2 wages. We don't hire anyone, but we do have a property that earns us $300,000 a year. $300,000 a year is roughly $25,000 a month, which would lead me to believe that that would probably be something that would apply to a $3 or $4 million property. So let's go ahead and put 3 or 4 million here. And that could be spread out. You know, like we could say that these are buildings 1 through 9. So it's 9 buildings, 300 million is the total value, 300,000 is the total income. The tests are based on the greater of these two tests. So we only have to have one test populating. So in this case, it's 75,000. Our $60,000 deduction, 20% of our income, is still going to apply, no problem. 20% of 300 is our 60. And so we're not limited by the test of 75,000. And so we get to take the full amount. So as you can see, this is really a real estate deduction, but thankfully, at least people under the threshold basically get to just take the 20% of the net pass-through income.
Okay, that's all for the 20% QBID deduction. I hope this helps you understand the deduction. I teach people how to use Free Tax USA, and there's a bunch of videos in the description below, including if you have a business or rental property, and they take care of the QBID deduction for you. You just need to know the amount that goes into that. It's your net business income, and confirm that amount. Keep in mind, it's your net business income after your deduction for self-employment taxes, as well as any other deductions for AGI, which, like I said before, health insurance under the business and retirement plans that are through the business. If you enjoyed this video, give it a like to let YouTube know. Otherwise, I'd love to hear your questions, comments below the video. If you're new here, consider subscribing or check out all the other information I have in the description below this video and other videos, and I'll see you next time. Bye.